Hello and welcome to Big Deal. As this financial year comes to an end, it's a perfect time to take stock of how the deal street fared and what is the outlook for the new fiscal. Joining me are Prashant Mehra, the partner at Grant Thornton Bharat, and Gaurav Sood, the managing director and head of equity capital markets at Avendus Capital. Gentlemen, so good to have you on CNBC TV18. Now, Prashant, starting with you, give me an overview of how the M&A really panned out and overall deal street in the last fiscal gone by.
Anisha, thank you for having me. I think the year's been interesting. FY24, as we call it, which is the Indian financial year, we saw about $80 billion of deals passing through. While this is substantially lower than what we saw last year, which was about $130 billion or so, and the year before that about 110. Interestingly, the deal volumes have remained almost the same as last year, 1,700 this year as opposed to about 1,800 in the previous year. But the mix is something which has undergone a tremendous change. We've seen a very low both volume and value of domestic transactions. Private equity transactions have really maintained the same same volume, but the value has been lower. Inbound transactions is something that we've seen a huge surge, both in terms of value as well as volume. 60 deals to about 80 deals in this year, 20 billion to moving to about $85 billion. As far as outbound is concerned, that's been also subdued. I think there are 2-3 interesting things that we're seeing here. One, there is a heavy concentration as far as the Indian market is concerned. And also the India brand seems to be doing well in terms of the global transaction scenario, which is why a lot of inbound is happening. Outbound, not so much. Private equity continues to believe in the India story, but at the same time, there's been a value correction. As far as domestic M&A is concerned, yes, value, volume both have come down, which again seems to be that the markets have been choppy. The geopolitics has been playing over this, and there's been some major valuation corrections as well. And probably something to do with the budget as well, which is just around the corner. So that's really been how transactions has fared during the last financial year.
Right. So Prashant, you highlighted many factors. And of course, going forward ahead of the elections, the deal street is in a bit of a status quo. But the big highlight for me for FY24 has been the capital market transactions. And that's also one of the big reasons why other deals, and especially private equity deals and investments, didn't take place because of the equity market valuation as well as the large number of block deals of close to about $25 billion. Gaurav, jump in on this. And what's your analysis from the capital market transaction of the last fiscal?
Sure. Thanks, Nisha, for having me here from Avendus. I think clearly FY24 was a very different year in terms of capital markets versus some of the last few years. As you rightly said, I think it was the year of block deals. And obviously, I think one thing clearly emerged is that India was becoming more and more acceptable for global investors, both from investment perspective. So we saw large global investors come and participate in some of these block deals, but also from a private equity perspective. Clearly, in the past, one of the clear exit mechanism used to be secondary sales or private transactions, but blocks became the preferred mode of exits for a lot of these private equity funds, where overnight they could look to sell anywhere between 20, 25, 30% in a reasonably large company from a market cap of 20,000 crores to somewhere about 50, 60,000 crores. So $1 billion blocks got done overnight. And overall, as you said, 25 billion worth of blocks got done. So clearly, India is becoming more and more liquid, mature, stable. Today, people are ready to accept companies with 100% float, no real promoter, with a strong management and CEO driving the company. So clearly, the year of block deals, and obviously, we expect this trend to continue. As we have seen even in this quarter, large blocks have got done, and some of these large global MNCs have sold stakes in Indian subsidiaries, as well as large private equity blocks we saw. So clearly, this trend is here to stay as India becomes more and more liquid and robust.
That's right, Gaurav. So that's a big highlight of last fiscal, and you're saying that that's going to be carried forward for the next fiscal as well. Of course, a lot has to do with the equity market and also the valuations of the equity market, and especially with elections going, a lot really depends on this big event is what I gather. But Prashant, tell me one thing. It had an impact on M&A in the last year. Do you think that as more and more investors realize that you don't need to wait for a strategic deal and can exit through blocks, do you think that more imagination, innovation, and talks for strategic deals will eventually come down? Is that the trend that we are seeing?
Nisha, if I know the transaction market well, I think as far as exit is concerned, they'll always be very creative. And that's something that is required as well. So no, I don't think so. The creativity as far as exits is concerned, which is something that will go down. If you look at the stats, IPO market, yes, but IPO, QIP together, $160 billion has been transacted during the year, which from a last year perspective is double on what it was, both from a deal value and volume perspective. But I think, the value, $160 billion is a lot of money as compared to last year. And the year before that, of course, was post-pandemic. So it was 2 years combined into 1 year. But just last year has been phenomenal in terms of exits. The reason why domestic M&A has been down is perhaps because the cost of business went up drastically because debt became more expensive. And the focus was really not on acquisitions, but on making sure that there is good growth and hopefully leading to an IPO story, which would give them an exit sometime. So I think besides everything else, FY25, that IPO QIP story should continue.
All right. So Prashant, you made some very interesting point, and you also highlighted another economic macro factor which impacted the deal street, which is the interest rate. Now, we are all waiting for that event also. So for this year, apart from elections, turn in the interest rate cycle is another very big aspect. How do you see that really impacting? And especially after a very long pause, the capex plans, especially from the big, large conglomerates, has really made a comeback. So how are you seeing the way forward? And do you think that that also means some of this growth opportunities will trickle into larger acquisitions and consolidation by the bigger players? I'm mixing up a lot of factors coming together for the deal street view.
Whenever, there are some sudden changes, and that happened between the previous financial year and the current financial year, there is always a momentum that you see that, dies down and then it comes back again. I think the interest rates have been stable for the last quarter or two. I don't expect really interest rates to go up going forward, but stay stable or go down a bit. And I think that would fuel a lot of investment going into infrastructure. I think two more areas of capital is something that we should not ignore. One is the foreign capital coming into India. I think India's macroeconomics, the brand position, the India story, rather I would say the Bharat story, everything seems to be there. There's a lot of interest coming into India, and I think that will only increase. And the third bit is that what I consider the alternate source of capital, which is the private equities, they will soon start funding companies as well, especially the non-listed mid-market companies, in terms of both the strategic acquisitions, consolidation in the market, and fueling further growth. So I think the combination of these three things should see a lot of investment coming in, whether it's debt or equity.
All right. Very well summarized on that part. But I would say that the conglomerates and the animal spirit in the top corporates, that has seen a major shift. And that could be something that could take the deal street forward as well, because in terms of might, money, power, deep pockets, they stand the best chance. Now, Gaurav, talking about the IPO market, of course, this particular year, fiscal year, has seen small ticket sizes in terms of IPO compared to the last year, and also many but smaller. So volume play was higher. But I would say that some of the highlights for me in the last couple of years has been that the conglomerates, again, have scaled up their business. And after a couple of decades, many of them have come with new offerings and new listings. Let's talk about the types of Tata Tech, JSW, and Birla Group a couple of years back, and Piramal a couple of years back. So this is becoming like a trend. What do you have to talk about this and the way forward when it comes to the conglomerate action on IPO Street?
Yeah. So Nisha, clearly, I think within the conglomerates, there are obviously various businesses which these companies or these conglomerates have incubated for last 8, 10, 15 years. And with the strong appetite in capital markets, with the strong brand name franchise which some of these businesses represent, it was good time for them to look at public markets, because as public markets need large stable businesses, the fact that some of these businesses come from large brands, very well established, already having listed companies in the capital market, having delivered shareholder return over the last decade or even more than that. I think it was great time for some of these conglomerates to start thinking. There are 4 or 5 examples you already mentioned, but I think there will be many more IPOs that will come in FY25, 26 from these conglomerates across sectors, whether these are traditional sectors in financial services, infrastructure, or even some of these more newer age businesses. You will see a mix of both old school businesses as well as newer age businesses to hit the market from a conglomerate perspective. It's good time for some of these conglomerates also to get value discovery, price discovery for some of these businesses where they have pumped in money as well, and there is no real private investor, or maybe in some cases there might be a private equity investor in some of these businesses.
All right.
So it's good time. It's a good mix of these IPOs that will hit the market in the next couple of years.
That's right. Couple of years, a lot of very big companies could be really rolled out from the conglomerates and large business houses. And we have to see those that could really change the way the dynamics of the equity markets work and create new heavyweights in the market as well. All right, hold on to your thoughts. We'll come back and discuss more about the Deal Street outlook for FY25 right here on Big Deal.